I did the rookie podcast mistake of not clicking record in the beginning because I had we had such a fun conversation about all things Africa. But I'm so pumped to have a South African on the show that gets Bitcoin, but also has their toes, if not their whole foot, dipped in the institutional world. So welcome to the Why Bitcoin show, Glenn.
Thanks for having me, Dale.
Yeah, what a pleasure. Well, I think I've got about probably 25 questions here, but I think we do not have the time. So we are going to jump straight to it. But I think you're not someone on Twitter who's making a big hoo-ha about your views. In fact, I don't even think you're on X. So um, perhaps for the listeners, would you give us a really brief overview of kind of your professional background and what is you find yourself doing today and how it relates to Bitcoin?
Yeah. So I got fascinated by finance as a teenager. My dad had some friends who had a proprietary trading firm in Johannesburg and spent a lot of time with these guys. My dad used to play golf with them and I like showed some interest and they started inviting me to the office and kind of showing me things as a teenager. And that kind of like locked me into the idea of studying finance and investment management and all that kind of stuff. And so after I finished studying, I came to London with the specific purpose of becoming a trader. And I started off by filling it in envelopes at UBS. And then I got a job at a proprietary trading firm, an American firm. They've got offices in all the major financial centers around the world, but they had a trading floor here in London. There were 105 of us on the trading floor. And I did that for about 3 years. And then I basically took my own money and put it up at a prime brokerage called Revco and traded there for 2 years using my own money. But Revco was the largest bankruptcy in European history. They went bankrupt and all of our capital was commingled with theirs. So
Mm.
everybody on the trading floor, there were over 300 of us, lost all of our money. But it's a very precarious existence trading. You can kind of, you can lose like 2 years worth of work in 15 minutes.
Yeah.
It's brutal because it's all P&L based. So you get like a pathetic basic, you know, minimum wage,
Yeah.
right? But you take 40% of all your profits, right? So if you're like €1 million up, it's looking like you're going to get a 400,000 euro bonus. And then you have a bad day and you lose it all in like 15 minutes, right?
Yeah.
So it's that kind of existence. And also you can be underwater. So you can be like, Jeebus, I've got a year's worth of work just to break even. I studied the CFA. I was like, yeah, I got to get a real job. I can't be doing this for 30, 40 years. I'll kill myself. So I studied the CFA and I got a job at an American investment consulting firm called Wilshire Associates, also here in London. So I spent 5 years there and I worked with all different type of institutional investor types like Dutch pension schemes, the State General Reserve Fund of Oman, which is their sovereign wealth fund,
Mm.
Central Bank of Egypt, you name it, every type of institutional investor doing investment consulting. And then I became the head of investment consulting at Old Mutual and spent 5 years there. And then also worked at Sanlam. I was the head of the asset allocation committee at Sanlam and I worked as a portfolio manager managing multi-asset class portfolios and was also a co-manager on their alternatives portfolio. And then I joined an investment consulting firm in London. And we basically, at Sanlam, I also kind of set up their Bitcoin infrastructure or their actual, I hate using the word, but their crypto kind of infrastructure to get their clients access. And then I got offered a job here in London as an investment consultant and the head of digital assets. And my kind of mandate was to get pension schemes to invest in Bitcoin. And so we did manage to get the first British pension scheme to make an allocation in like October last year. And we used the firm that I work at now, called Onramp Bitcoin,
Yeah.
as the custodian. And so I got to know them really well. And so they offered me a position, and I'd kind of been for 4 or 5 years been saying, okay, how do I go 100% into Bitcoin? And then it just kind of got offered to me. So I was like, okay, let's do this.
Yeah.
So
What a
yeah.
storied career you've had, hey? I mean, honestly, probably one of the more illustrious guests I've had, and just in terms of the diversity and breadth of experience, the description of trading is like, it's a hell of a stressful endeavor. I can just imagine it's not for the faint-hearted, and I think the failure rate's incredibly high. And then, yeah, just covering all sorts of asset classes across the years, all sorts of different roles. We find ourselves today. It's 24th of April, 25, and now we're in a fascinating period of time where it just feels like I mean Bitcoin's up from 84, where it seemed to be stuck for the last couple of weeks, but we're just in this very interesting period of time. Post-Trump tariffs, people are wondering if there's a liquidity cycle that's about to begin. I'd love to just sort of let's just zoom right out and how are you thinking about things from just a big picture macro perspective right now? Um, yeah, and we can go from there.
Yeah, sure. So, I mean, for me, there's one thing sort of driving everything else, right? And that is sovereign debt, right? So if you use the United States as an example, so if you look at the income and expenditures for last year for the US government, right? 4.92 trillion were their total income or receipts, and 6.75 trillion was their total outlays. But of that, so of that 6.75 trillion in outlays, 5.124 trillion is mandatory expenses. So we're talking about Social Security,
Hmm.
we're talking about Medicare and Medicaid. We're talking about the net interest on the debt. We're talking about income security, so like unemployment kind of stuff, and veterans benefits and services. Just those add up to 5.124 trillion. Okay.
Yeah.
And the total income of the government is 4.92 trillion. So even if they just paid what they have to pay, right, they would have a 200 billion dollar deficit, right? But that does not take into account the military, which I don't know if you saw, but over recent days they've announced that the the defense bill, the new defense bill, is 1 trillion.
Oh, really?
Yeah, and last year it was 874 billion. So that's a 16% increase in national defense spending. But then there's education, there's transportation, and then there's everything else that the government does, right? And so, for example, a lot of noise has been made about the USAID and Doge kind of uncovering all these kind of, which look, I mean, I applaud. I think corruption and abuse and stuff like that should be rooted out regardless. But in terms of whether it actually moves the needle, right? Like the whole USAID program was 42%. I mean, $42 billion, right? That is, so I've got a chart, right? But because a lot of people are listening, I'll try and explain it. But it's kind of a chart showing the breakdown of the government's expenses, the US government's expenses. And it's kind of done in those blocks. So you can
Yeah.
see the relative size of the investments.
Yeah.
USAID is not even the size of a pinprick,
Yeah.
right?
Infinitesimal.
So it's like even if you, so basically it's the Lynn Alden thing. Like nothing stops the strain, right? Like there's no way out. You as an individual, you can't get into $10 million worth of debt on $100,000 income and think there's a way out. There's no way out, right? But the way that governments go bankrupt is very different to the way that individuals go bankrupt. The way that governments go bankrupt is they don't go bankrupt because they can create money out of thin air. So it wouldn't matter how much debt you had if you could create money out of thin air, right? So, and we've seen it throughout history. The analog, and I attribute this to Linolda and it's her work, but essentially she shows the last time, because the last time we had debt to GDP levels at this level globally, right, was after the Second World War.
Yeah.
We've never even come close. Like if you look at the inflation that we had in the 70s, the debt to GDP in the US was like 30, 40%, right? So they could jack interest rates to like 15, 16%, and it was fine because there wasn't that much debt in the system, right? But you try and raise interest rates to 15 or 16% when debt to GDP ratio is 120%. I mean, you'll cause something 5 times worse than the Great Depression.
Mm.
Right? We saw what happened in the 1940s. In the 1940s, the debt to GDP ratio fell from like 120% to 53% in 3 years. Right? So how did they do that? Right? Well, they just let inflation rip and keep the Fed funds rate at like 2%. So inflation was like 15, 20%,
Mm-hmm.
and the federal fund rates was 3. So the difference is how much you're inflating away the debt. So if you inflate debt away at like 20% a year, you've only got to do that for 3 years, right? And you've suddenly gone from 120% debt to GDP to 60% debt to GDP, right? This is the playbook. This is what's coming, right? I think it's sort of like, obviously the investment community is alive to the risks and whatever, but I don't think they've quite gotten to the point where they're like, this is happening, this is inevitable. Like we're
Yeah.
gonna have, and it's like Ray Dalio always says, right? Ray Dalio always says, there's loads of things that I've never seen before, right? Because they've never happened before in my lifetime, but they've happened loads of times in history, right? And so he kind of did this kind of study going back like 2000 years all the way to Rome and looked at all the empires that have risen, had the reserve currency, got into a whole lot of debt, right? And then what happens, right? And it happens every like, on average, sometimes it can go 250, 300 years. Sometimes it only takes like 30 or 40 years,
Mm.
right? But on average, it takes place every 80 years or so. And you can also kind of tell when it's coming because there's certain things, there's certain indicators that start happening. Like super interesting one now is that you see short-term inflation falling, you see risk assets taking pain, and yet treasury yields stay elevated, right? And that kind of behavior where the sovereign bond doesn't act like a safe haven is what you see in emerging markets, right? Because
Mm.
what bond investors are, because that's what always happens. Like if you look at South Africa, where we're from, right? If the stock market falls 3%, believe me, the yields on the bonds are going up, not
Yeah.
down,
Yeah.
right? Because it's like the whole country's seen as risky. So once you start seeing that in the developed markets, like in the G7, right? Particularly in the US, but
Mm-hmm.
also in Europe and the UK, then it's kind of telling you that the bond market's saying, listen, I know historically 5% yield on a 10-year gilt or 10-year US Treasury sounds attractive, but if inflation runs at 20% for 3 of those 10 years, I mean, the real return that I'm going to get is ridiculous. So you don't have enough buyers, right?
Yeah.
For the debt at the current interest rates. And I mean, again, using the US as the prime example, because it's a reserve currency. They've got to refinance $10 trillion worth of debt over the next 12 months. 9 trillion of refinance debt, so just rolling over existing debt, so reissuing it, plus about another trillion and could be closer to 2 trillion. So it could be 11 trillion, right? For the global financial markets to absorb that amount of debt in 12 months, right?
Mm,
Particularly when, I mean, you also look at gold, right? The gold price has doubled in what's it, like 2 years.
yeah.
Right? So all the indicators are there. Like gold doesn't double. Financial markets don't behave like this. Governments don't magically get rid of all of their debt. And the solution is currency debasement, right? That's what we saw in the 40s. That's what we've seen loads of times in history. And that is what we will see again. I don't know if it's going to take a year or 5 years, but I would say it's closer to a year than 5 years. And we are going to see, what Larry Lepard calls the big
Yeah. Yeah,
print.
the big
Right?
print. Now,
We are going to see something we've never seen in our lives before, for sure.
can I ask this question now? So, so the US, I think debt to GDP is like high, 120% or something like that, right? I think the UK is what, like 100 or something like that.
6 or something like that,
Yeah,
yeah.
Canada's similar. Australia, I saw was like 55%. So it feels like, even though I know there's a huge amount of loss of confidence in the US dollar, but how does it fit within the picture of other markets that have far more conservative debt to GDPs? Like I saw Russia's, and I don't know if we trust that data, but it's like it's not even 20%, versus Australia or 55, and then you look at something like the US. Like, how do other markets fit into that analysis?
So the thing is that it's a little bit deceiving to look at like the actual public debt versus GDP because that's just like the explicit debt. Like a government has issued a bond and borrowed $100,000 or pounds or euros
Mm,
or whatever, right? That's all that that's measuring, right? So let's use the UK to use a different example. So here you get a state pension. Okay. So the way it's meant to work is every month you get paid if you're like an employee, right? Or I suppose everyone's employee, even if you own your own company.
mm.
And then you get paid a salary, and the employer and the employee pay this thing called national insurance, right? Now, commonsensically or theoretically, you would think the government would be taking that money and putting it aside for when you retire, because that's what it's there. It's for your state pension. That's why you're paying that national insurance, right? But the government doesn't do that. They take the national insurance and spend it on whatever that needs to be spent, right? So they don't put any money aside. But at the same time, they're promising me, like when I retire, I think I get about on the order of £1,200 a month or something like that from the government.
Yeah.
That's what I'm kind of promised. If I work out another 10 years, if I do all the calculations, whatever, they're going to give me £1,200 a month. But they don't have any of that money set aside. It's not like a pension scheme where I'm like putting money in and they're investing it carefully. And then when I retire, the money's there and I can slowly withdraw from it, you
Yes.
know. No, they got not one brass farthing set aside for millions of people to retire on. So in my last job, I was doing investment consulting for defined benefit pension schemes. So like the way it works with the defined contributions pension scheme, or I think they call them superannuation
Yes.
schemes
That's what we have. Yeah.
is that you put money in, your employer puts money in, and then at the end, it's like depends how well your investment portfolio is done, then that's how much you can retire on. You can take the money and buy an annuity, or you can leave it in the portfolio, just draw a percentage down on it every year or whatever. But it's like there's real money there, and it's kind of dependent on how well your investment portfolio does, how well you're going to retire, right?
Yes. Correct.
With the defined benefit pension scheme, a company says to you, Dale, listen, you've worked here for 30 years, okay? they tell you this when you start working there. We're going to give you, I'm keeping things very simple here, right? They've got formulas and whatever, how they work it out. But they say, listen, when you retire, we guarantee you, we're going to give you 70% of your salary for life every month, increasing by inflation, right? So now all the risk is on the company, right? And so they're putting money in and the employees are putting money in and whatever. And now it's like we're calculating what the present value of the liability of paying all those pension schemes in the future. We say, okay, the present value is like 500 million. What are the assets? Oh, the assets are 450. So we're 90% funded. We've got to grow these assets, et cetera, et cetera. And the value of the liability keeps changing because the present value changes as the yields change,
Yeah.
right?
Yeah.
And so how does this translate back to the state pension? Well, if you calculate this, so the explicit debt in the US, like, they've issued bonds and borrowed the money is about 2.3 trillion.
Yeah.
Okay. But then if you do a present value calculation of the state pension, it's about 4.3 trillion.
Mm.
Right. And then it's kind of ironic because the UK government say to all the private sector businesses that have got defined benefit pension schemes, got all these rules and regulations, like you don't have enough money in your pension scheme, you're going to have to take company money and put more in, et cetera, right? So they're super stringent, all the companies. But then the government itself has defined benefit pension schemes for the people who work at the National Health Service,
Yeah.
who work for the firemen, the policemen. They've all got defined benefit pension schemes. They don't have 1 cent set aside for those either. Right? So you got to add about another 1.5 trillion there, right? So you add the 2.3 trillion to the 4.3 trillion to the 1.5 trillion, right? You're already at like 7.8 trillion, right?
Mm.
And then they want to do net zero, right? Which is just totally insane. They've just spent 30 billion pounds on carbon capture equipment,
Yeah.
right? Which is, I mean, these people have lost their minds, right? Basically, if you do it all in a spreadsheet, if you work out the current portion of the payments that they have to make to the state pensioners and to the NHS and to all the defined benefit pension schemes and all the mandatory expenses of the thing, right? You just realize it's impossible. They could tax everyone 100% and it wouldn't be enough, right? The only way they can do it is to borrow more and more and more. And as they borrow more and more and the debt burden becomes more severe, investors look at that and go, oh, we know what's coming. You're going to have to print money to pay me back. So I'm going to demand a higher interest rate. So interest rates or yields on long-term bonds go up, right?
Mm.
Because they want to be compensated for the inflation that they're expecting. But then that starts to cause problems in the economy because now all of a sudden people can't finance things because interest rates are too high or whatever. So it's just a matter of time before you run into liquidity issues or whatever. And then I don't think it'll be explicit, or they'll try not to make it explicit. They won't have the Fed or the BOE or something go out and just do massive QE or something like that,
Yeah.
right? It'll just be from a PR perspective, an absolute and political perspective, an absolute nightmare. It's like because people are familiar with all these things now, so they can't just do these things. So they'll find stealth ways to do it. Like one way to do it is lie about the inflation numbers. Like here's what's super interesting. We wrote this report. It's called the inflation illusion, right?
Mm.
There's this company. Let me see if I can remember the
It's not
name.
trueflation, eh? Not those guys.
Not trueflation.
Yeah.
It's something index. I'll get it'll come to me and I'll mention it later, but the name of the place. But there are a few different places that do it where they just take, it's subjective to a certain extent. They say, okay, what do we think the most 150 most so consumed things are by all families? So it's things like butters, egg, orange juice. Like anybody would agree, yeah, this is a pretty representative. basket, but they hold the basket constant and they just measure it every year, right? And in the US, if you use that basket, inflation for the last 10 years has ranged between 10 and 15%. Right? If you look at the increase in the US money supply, okay, if you look at it over a 60-year period, right, the average increase in the money supply per year for the US dollar has been 7%. But if you look at it over the last decade, it's 11.82%.
Wow.
Right? So you would expect, logically, that if they're increasing the money supply by 11.82%, forgetting about productivity gains and natural prices lowering, right? You would expect prices of things to go up by about 12% per year, right? And it turns out that if you just measure 150 of people's sort of basic needs, the inflation is about that,
Yeah, once you
right?
don't play those games of like hedonic adjustments and all that jazz, like, oh no, we used to have grass-fed beef and now we're just going to give them this awful, mincemeat or whatever the case may be. And, it's only gone up 3%. What are you bitching about? Um, yeah, 100%. I mean, it's become so increasingly obvious that, like to your point earlier, they can't do, you know, um, I guess they can't do something like QE blatantly. They can't lie about, I think, inflation so blatantly anymore. And I think part of it is just the sheer availability of information, the digital kind of revolution of information. And I'm so grateful to have all this information now at my fingertips, although sometimes it can drive us mad, but it does help us see, you know, around the curtain, so to speak, and go like, these guys have just been pulling the wool over our eyes for God knows how long. You said earlier, like, these dynamics between the bonds and gold and things like that. I mean, gold sniffing out that there might be some liquidity on the way. But at the same time, what we've seen is Bitcoin has rather unusually seems to be, I don't know if it's uncorrelated, is it decorrelating or what's the word here, but seems to be decorrelating from, the QQQ and other sort of indices that would measure, I guess, tech stocks and the like. Um, do you think that's a short-term trend, or are people starting to now price Bitcoin and go, this actually is now a risk off, as opposed to have it been risk on, I'd say, arguably up until this year, even maybe 24.
So the way I kind of think about it is, I can't remember what the name was, but at university, when you learn about bond markets and the yield curve and stuff like that, they would kind of there were I think it was called preferred habitat theory. So it was like there was different ways of like kind of predicting where yields were going to go and stuff. But one of them was preferred habitat theory. So, for example, certain types of investors buy the long end of the curve just because it kind of makes sense for the investment strategy or objectives or whatever. Whereas some are going to be buying bonds near the short end of the curve. So that can kind of change the shape of the yield curve. In the same way, I think there's people buying Bitcoin for different reasons,
Yeah.
right? So, for example, like a hedge fund, right, is buying a Bitcoin for a very different reason than a sovereign wealth fund or, a Bitcoin maxi.
Yeah.
Right? And so it's sort of that's why Bitcoin kind of it trades like a take stock. It trades like one of the Mag 7, right? Like what's super interesting is people like go, oh, Bitcoin's too volatile, but they've got all of the Mag 7 in their portfolio. And then I just show them that every single one of those is more volatile than Bitcoin, right? With a quarter of the return. I'm like, so okay, so do we accept that it's not too volatile to be part of a portfolio? But so trades like a take stock because you've got like a certain group of investors who kind of investing in that kind of tech growth kind of perspective on Bitcoin, right? Then you've got like other investors who see it as a store of value, right? More like a digital gold or something like that. And so it's like with gold, there's only one reason why you're buying it, right? You're not expecting like all of a sudden, something revolutionary to happen with gold. Whereas with Bitcoin, you've got that kind of, I hesitate to use the word, but there is a speculative component to Bitcoin. Like even the speculation about how far and how fast is this going to go? That's a speculation,
Mm.
right? You can think that Bitcoin's inevitable, but inevitable over what time period? 1 year or 100 years? Nobody knows, right?
Mm.
So it's like you're betting on that, right? Because there's a time value of money. So if you think that's going to happen quicker, right, then you're going to be making a higher allocation to Bitcoin. If you think that that's going to take longer, you might invest less. It's so I think that, and it obviously depends on the macroeconomic backdrop, right? So, like for example, when we saw SVB, and Signature Bank and everything go bankrupt,
Yeah.
also Credit Suisse went bankrupt.
Mm.
Their Bitcoin behaved like a safe haven asset, right? And then you see in other times, like for example, the beginning of COVID, right? Bitcoin absolutely crashed near the beginning of COVID, right? Because I think it's also like dependent on what time frame you look at. Because if you look at like the day after a crisis, Bitcoin's usually the one that takes the biggest hit, right?
Yeah.
If you look 60 days after a crisis, Bitcoin's outperformed everything else, right? So it's sort of, it's like watching a kid grow. Like when they mark kids' heads on their
Yes.
height, all
Yes.
like
Yes.
that. And it's like if you don't do that, you wouldn't realize that the kid's grown this much in a year. You would miss it,
Yeah.
right? And it's the same with Bitcoin. It's like because you're focused on the, oh shit, it was 108, now it's 75, what the hell's going on? But you forget that that all happened in like 45 days,
Yeah.
So if you just kind of step back a bit, then the picture becomes clear again. Like I think the short-term movements in Bitcoin, I mean, obviously they're for real reasons. I mean, it's buying or selling. But the reasons why people are buying and selling, it's just noise. Right?
Yeah.
It doesn't mean anything. Like my wife will be like, "What's going on with Bitcoin?" Because we've got a lot of money.
Yes.
I'm like, I don't know what's going on with Bitcoin. Bitcoin's just being Bitcoin. You
Yeah.
know,
That's exactly right. Now I get exactly the same question. I think as does every Bitcoiner's partner. It's like, what's going on? We're like, we don't know. But I remember reading a report some time back from BlackRock, which described exactly what you said, 60 to 90 days following some sort of crisis, geopolitical, economic, whatever it might be. I think the Ukraine invasion was an example. Bitcoin's the most liquid, and especially if this happens like over a weekend, it's 24/7. It's the first thing people want to offload, before market opens. So, yeah, but then it seems to do better over 60 to 90 days. To go back a little bit to when you were saying, look, you had effectively Orange pulled the first pension fund in the UK, and now you find yourself at Onramp talking probably exclusively to institutional investors who are looking to make an allocation. I'm interested to get your take on kind of where we are in that cycle because I remember the likes of Raoul Pal, who I fondly call Rug Pal. The institutions are coming in 21. It was probably just, hedge funds and some degenerate trading firms and all that sort of thing. But some really interesting news, coming out just like the last few days. I see there's a crowd called Abraxas Capital Management. They bought 250 million pounds worth of Bitcoin and actually took it into self custody. Didn't buy an ETF or anything. And then we see today, or at least today here in Oz, the launch of 21 Capital with Jack Mallers at the helm, buying 42,000 Bitcoin. So it feels like it's gaining momentum. So I think it's an obvious question, but my question is more about like how far along are we, and is there still a lot of career risk in being someone who wants to talk about Bitcoin at an institution?
Australian friends, last year I set up a self managed super fund because I was fed up of mediocre performance and my fund clipping the ticker 1% whether it went up, down, or sideways. When I asked them, what are you actually invested in? They said it was confidential. Oh, I see. You take risks with my money, get paid no matter what, and then refuse to tell me what you're invested in. So rather politely, I told them to GFY and I set up my own super. And that's proven to be the best financial decision I've made since buying Bitcoin. And of course, you can buy Bitcoin within your own self managed super. It's not difficult to get started. And if you're keen to learn more, email me at dale@bitcoinmentor.io or set up a discovery session. The link is in the show notes. Now back to the show.
So thankfully, I don't care what anybody thinks about what I say anymore. I mean, obviously I do care, but
To a point.
I don't have to not say things that I believe,
Yes.
that are, legitimate. But so where are we? I mean, so in reality, we're so early, right? It doesn't mean that there aren't hundreds, thousands of companies and different institutional investor types, from family offices to endowments to sovereign wealth funds to companies looking to invest in Bitcoin. And I'm having 20 meetings a week. We're onboarding an endowment at the moment. We're onboarding 2 companies at the moment. But I mean, our pipeline's just chock-a-block, right? But so, if you're sitting in my seat, it's like, okay, this is all happening, and it is, right? But in terms of, percentage numbers, it's tiny. I mean,
Yeah.
it's like literally 0.25% of companies. Still 10 or 20,000 companies, like private and public, right? But compared to, millions globally, right? It's still a drop in the ocean. The number of pension schemes worldwide is between 10 and 20 that have done it. The number of endowments, single figures. Family offices, I mean, it depends what figures you believe, but it's anywhere between 10 and 30% have gotten exposure to digital assets. But a lot of them are involved in like Web3 and all this
Oh
rubbish.
boy.
They're
Okay.
just misled,
So when
XRP
so
or
these
crazy.
guys, when they're making the allocation there, Glenn, are they how much of their their assets are they looking to allocate? Is it sort of the kind of single percent, kind of like one or two kind of thing? Yeah.
Yeah. I
Yeah.
mean, like if you look at a map, like one of those kind of charts with the blocks for the different sizes of the different investors,
Yes, yes,
right?
yes.
In Bitcoin. It's like 65-70% of Bitcoin is still held by individuals, right? It could be on an exchange, could be on a hardware wallet in the lounge, could be in a multi-institutional custody vault, but about 65-70% of the total supply of Bitcoin is still held by individuals, right? And so that's just a reality, right? We've got clients, individual clients with more than 1,000 Bitcoin. I mean, 1,000 Bitcoin is a lot of Bitcoin, right? But for institutional investors, I mean, what you have to understand, right, is different investors, they're investing for a reason, right? Like for us as Bitcoin maxis, we're just like, I just want to have I'm investing this money and I don't have a specific plan. I just want this to go up forever, and basically not have to worry about money. Right? That's about as far as the planning sometimes goes, right?
Mm.
Whereas with a defined benefit pension scheme, it's like, no, we need gilts plus 2.5% for the next 7 years, right? So if I can get gilts plus 2.5% with almost no risk, that's what I'm going to do. I'm not going to go and invest in Bitcoin or, you know, venture capital or something because I don't need to, because I've
Yeah.
got an objective. Once I hit the goal, I don't get any points for exceeding the goal.
Mm. Yeah.
Right. And it's the same with a lot of things. They have different reasons why they're investing. So they want to control volatility in the portfolio because say they're withdrawing a lot of income from the portfolio. They don't want the portfolio doing this, right? They've got a return objective. They've got liquidity constraints. So they can't invest in illiquid things. They've got a time horizon. Like, are they investing before they need to, are they accumulating or are they distributing, right? There are all these different factors. And so, like, we've got this endowment that we are onboarding now it's 100% Bitcoin allocation, right? So 100% of the entire endowment is going into Bitcoin, right? But then on the other end of the scale, we've got like pension schemes with like a 3% allocation, right? And what's driving that, I mean, there are human psychological factors, but it's also because of the investment strategy. What are the investment objectives and constraints and unique circumstances of the institution that's investing? So it's like if they tell me, listen, I don't want my standard deviation on my portfolio to go above 15%, right? I mean, it's not a guarantee, but I'm designing the portfolio for that. I can't put 20%
Yeah, that
in
makes
Bitcoin.
absolute sense.
Yeah.
Yeah. So something like even a Pierre Rochard's bit bonds probably wouldn't be of interest. That's probably more for the corporate market, would it be? Like, because it's an interesting product, whether it's like 95 or 98% bonds, the balance being
I think that
Bitcoin,
could work. I
you
think
know.
that could work. Because if it's like,
But I suppose having said all of that now, are you feeling like, and in closing today's discussion, I want to leave this on a relatively positive note because we've diagnosed the problem. Are you getting a sense that there's somewhat of a shift now, and that people are slowly becoming awake to the problem and that the politicians have been lying about what the true rate of inflation is, and they're debasing their money, and there are alternative ways out there. I mean, are you getting that sense, or do you think it still needs to get a little bit worse before it gets better?
I think that whereas like maybe 1 in 100 people would have understood, the last part of our conversation and would agree with it. Now it's like 5 in 100.
Yeah.
So it's 5 times as many as there were before, but there's still 95 people who like too busy picking up the kids from school and worrying about doing the grocery shopping and just trying to survive, right? And also like you come and talk to them about this crazy thing called Bitcoin that they've read all these dodgy things in the newspaper about. And also they don't really understand. It's all of this is just like I've tried to explain to my one uncle about why inflation occurs, like why prices rise. And it's not Vladimir Putin's fault I mean, you can have short-term supply chain bottlenecks and stuff like that, but that isn't what causes price rises long-term or whatever. We have spoken about it for hours, and I just can't get him to wrap his mind around it. I've like sat with marbles and set up like simple models. Okay, let's simplify everything. And you see, I'm dilute. He is convinced that it's greed, like you say, 95 or 98% normal bond with a little sprinkling of Bitcoin in there.
A little bit of
The
fuel.
overall asset is probably not going to be that volatile. In a lot of ways, it would be lower risk than a long-term straight treasury, right? So those kinds of things, and what's kind of weird is so you can do that in a portfolio without Bitcoin.
Yeah, exactly.
You just buy a bond and a bit of Bitcoin.
Yeah,
Right? You don't
exactly.
do it for you. So but so you can see it there, like with Bit bonds, it might be 2 or 5% Bitcoin. Well, if you had a whole portfolio of that, just 100% Bit bonds, then your overall portfolio would be 2 to 5% Bitcoin.
Yeah, yeah, 100%. Yeah.
You're back at the same story, yeah.
Yeah, that makes sense. Absolutely. I'm just a bit conscious of time. You've been very generous today, and I know it's a normal working day for you. It's evening for me. But I have one or two more questions. Have you got some more time
Yeah,
still?
yeah, go ahead. Yeah.
Perfect. Okay, so one of the things I was curious about was, when you're obviously talking to the institutional investor class, what I do on my day today nowadays is I'm talking to everyday people who are looking to self-custody. I'm a self-custody maximalist. So I like to look after my own corn, as it were. But I think institutions have a different need. I'd just be interested to get your take, coming from that institutional perspective, on the different approaches, whether it's for institutions or individuals, or and how that sort of, and the conversations you guys have internally about that.
So, I mean, okay, so I'll tell you now, in our current company, we don't try and convince anybody about Bitcoin, right? So our whole approach is we're dealing with companies who've already made their mind up about Bitcoin, or institutions. They're just looking for the best way to operationalize it,
Yeah.
right? The execution, the custody, the ongoing management of the asset, etc. Right? That's the part that they're not sure of. They've already decided to invest in Bitcoin.
Yes. Yes. Absolutely. Same with what I do. I don't sell Bitcoin. Yeah.
Yeah. But in previous lives, like in my last position, I was trying to convince people,
Yeah.
pension trustees about Bitcoin.
Yeah.
Right? I don't know if this is the right approach, but this is kind of how I think about it, right? Is, I can bring you some cool looking gadget, right? It looks amazing. It's in like this, you know, luminous green, and it's got all these cool things and whatever. And I'm like, how cool is this? And you're like, what the hell is it? Right? I think that that's what Bitcoin's like for most people. They're like, oh, it's like this weird thing that all these freaks are, making a lot of noise about and gambling on, and, you know, but they don't know what it is. They don't understand what purpose it has or anything like that, right? If I take that luminous green object and then there's some kind of problem in the real world, and then I take that green widget
Mm.
and I show you fix some amazing problem in the world or something like that, then you're like, oh, that's a cool gadget, right? Um, and so for me, it's like you got to understand that there's a problem, right? Like most people don't. It's like the watching the child grow thing. Uh, Most people don't realize where their life is so hard. Yeah. Like why their wife and them are busting their butts, and you know things are still pretty tough.
Yeah.
And they don't realize it's because of the way money works. Like most people never lived in a time when we didn't have. I mean, I suppose some people might have been alive before 1971, but even then it was kind of a quasi kind of gold standard or whatever. If you got a fish and you said it, so what's it like living your whole life in water? The
Yeah.
fish is going to go, what's water? Right? And it's like that with money, right? Like you get your $10 note, you go to the shop, you buy it, you just accept. Nobody ever looks at the $10 note and goes, where the hell did this come from?
Yeah.
Like who made it? Like what's required to make one of these? Like can people just make these things out of thin air? You know? And so I think it's very important for people to understand the history of money, the problem that has been repeated over and over again throughout history, right? Like this British pension scheme that we got to allocate to Bitcoin, they were manufacturing firm. I don't want to give away too much because,
Yeah.
confidentiality and stuff, but they were a manufacturing firm here in the UK in a very competitive industry. So they had no pricing power, right? But during COVID, because of all the money printing, their input costs went through the roof. So their margins just got squeezed. Right? They were selling like existing inventory at a loss
Oh,
compared to what, you know. So like when I spoke to the pension trustees, right? They all, like the financial director of the company was on the trustee board. And so I started off by explaining to them the history of money and how money works and what. After that, they were like, we're sold. We want to do this. Yeah. Because they, in their business, and also as employees in that business had a very real experience. Like everything I say to them makes perfect sense. And then I explain to them what Bitcoin is. Right? And then I don't need it becomes obvious,
Yeah.
you know. So it's always like because otherwise it's just like, oh, it's got 20, so who cares? And like what is this thing? And by what authority are Bitcoin made? And like all these kind of
Why can't you copy it? And what's
all
all
of
these
these
other things?
things, you
Yeah.
know. But I think the key place to start is like, look, there's a problem, right? And also it's like, you know, I like to point out to people, right, that everybody kind of knows buy a house, you know, buy a house. As soon as you can get on the housing ladder, buy a house, right? If you buy a house, right, and you kind of pump all your, you know, half of your salary into that house every year, it's kind of like a savings vehicle, and you know, to a degree greater than just bits of paper. There is a sort of a limited supply of houses. So it kind of makes sense to take these bits of paper that, you know, others can create ad infinitum and convert them into something where, you know, they can't do that as much,
Yeah.
right? But the issue is that you got to service the debt on the house, right? And so if you look historically, the household income with the house to household income ratio on average, okay? So for example, if we look here in the UK, was about 4.5 times. So let's say you and your wife earn $100,000 a year before tax, and let's say that's the average household income, then houses would on average cost $450,000, four
Yeah.
and a half times, right? Now in Australia, it's 12 times,
Yeah.
right?
Yeah.
In New Zealand, it's 11 times. In the UK, it's 10 and a half times, right? So it's like basically this is not going to work anymore, right?
With all of this stuff that's so obvious, Glenn, I mean, what you're describing is 100% the case. People basically use their house as a savings vehicle, whether they know it or not. They don't know there's a problem. They can't quite articulate it. They think this politician or this politician is going to solve the problem. Actually, it's just the money. The money's garbage. And the only reason why house prices now are so unaffordable is because, effectively, people who want to store their wealth in something that can't be debased are competing with people who just want to live in it. And so, take a place like Australia with all the incentives that we've got, negative gearing and all sorts of, first time home buyers incentives and whatnot.
And so the thing is that I think that like in the fullness of time, like nobody needs to be convinced about gold, right? Like if I go to that uncle and I say to him, hey, you should put some money in gold because, you know, it'll protect you from inflation or whatever. It's because it's sort of just like an accepted fact. Like the sky is blue, like
Mm,
gold is gold, right? Bitcoin hasn't reached that yet with 98% of people, right? But I think because it's such a small asset, it's only about a $2 trillion asset, not even, okay? Gold's like 30 trillion, right? That it requires way less capital inflows in Bitcoin for the market cap to go up than it does gold.
yeah.
And so I think what's going to happen is when the proverbial starts to hit the fan around the world over the next, yeah, it's probably 2 years, but let's, you know, hedge our bets and say maybe 5 years. But as like the realities come, the chickens come home to roost, right? And
Indeed.
they have to do what they have to do because they're not just nobody who can print their own currency is ever going to go bankrupt. So they're going to do it. They're going to have to do it. They're going to have bills to pay and they're not going to have the money. And the interest rates will be too high. So they will monetize the debt one way or another. They'll get the banks to do it through SLRs. They'll lie about inflation. They'll come up with these programs called the RQBD program to, you know, they'll make up all these acronyms and whatever. They'll try and obfuscate what they're doing and whatever. But at a certain point, the chickens are going to come home to roost and yes, it's going to be a relatively small percentage of people, their haven, their protection mechanism is going to be Bitcoin, right? But that's going to cause Bitcoin to, 2x, 3x, 5x, 10x. I don't know what it's going to be, right? But once Bitcoin starts getting to like a $10 trillion asset, whatever, I think there's going to be a Minsky moment for a lot of people where, you know what a Minsky moment is? It's like,
I should know, but I don't offhand.
it's sort of like, like how often it's like you'll know the tariffs are coming, you'll know the market's not going to like it, but like the market seems fine, right? And then the tariffs happen and markets drop 20%. And you're like, but we knew about it for 2 weeks.
Yeah.
We're like, you know what I mean? It's sort of like the sudden realization where it's like Wile E. Coyote, when he runs off the cliff.
Yeah.
And it's like he's running, and then he suddenly realized, and then only then does he drop.
Oh, yes.
Right?
Exactly. Yeah.
I think we're gonna have a Minsky moment like that with Bitcoin, where all of a sudden a lot more people are gonna realize what's going on. Like, and that's gonna be combined with like, you talk about the institutional world. To get this from the moment that the pension scheme made the decision in principle, yes, we want to invest in Bitcoin, to the moment when they actually made the allocation was 18 months. Okay, because of all the bureaucracy and the due diligence and the paperwork and the lawyers and the tax people and the auditors, and it's just red tape left, right, and center. And it's also like, oh, we need signatures on this form. Send the form. Takes 3 weeks to get a signature.
Yeah.
It's like that. And so I think a lot of things could line up here, right? Is institutions, I would say on average, take 18 to 24 months to do anything, right? And then also that could come at a time, and that's coming at a time when we're seeing much higher institutional interest, admittedly a lower percentage, at the same time that we run into the real things that people are worried about, that are on the horizon. And, also everybody wants to invest in Bitcoin when the price is running,
Yeah.
you know.
Unbelievable.
So I reckon you'll see the price run. And I think also once Bitcoin exceeds the market cap of gold, right? Then all of a sudden it's the penny's going to drop for people about what this thing actually is. And we'll get to a point where my uncle will think about Bitcoin like he does about gold. It'll just be
Mm.
obvious, you know. He won't even understand it like you and I do, but he'll just be like, but it's Bitcoin, obviously.
Yeah, what you said there makes perfect sense in the way that I see it happening. If the first target, so to speak, for Bitcoin is gold's market cap, once that has been achieved and surpassed, to me, the next thing, okay, there's always going to be a bit of monetary premium can be sucked from real estate. There will be some real estate investors maybe want to offload, but there were at some point there was like $18 trillion worth of negative yielding sovereign bonds, and you think to yourself like, how's that even an asset? Like that's a nightmare. I'm thinking that it will start eating the bond market because especially if people feel that we're in this sort of relatively high inflationary environment for at least another decade, largely due to the fact they're going to be monetizing the debt. There's going to be less and less attraction to something like a bond that is in principle, it will give you a nominal yield, but in real terms, you'll be losing money every year.
So it's super interesting because, like, if you and I think about investing in a bond, right? So, like, for example, today I could be like, I got this 100 grand that I don't know what to do with for the next 2 years. Oh, a gilt's offering me 4.3%, 2-year gilt. So I could chuck the 100 grand in there, get 4.3% income per year for the next 2 years, and then get the 100 grand back at the end, right? So it's like I decide whether I think that that's worth it or not. But with a lot of investors, they don't have a choice, right? So like for a defined benefit pension scheme, because their liabilities, the future cash flows, are getting measured using gilt yields.
Yeah.
To control risk, they have to invest in gilts, whether they think they're a good investment or not.
That's irrelevant. Okay, so to your point earlier, okay.
And
Oh
it's
man.
also like banks. So, like if a bank goes invests in equities or whatever, there's a capital adequacy charge.
Yes.
Again, like if you invest in something volatile, they have to put some of their own capital aside as like kind of a buffer,
Mm,
right? But I think what they're going to do is they're going to, and for like, you know, treasury bills, like very short-term government paper, there's no capital requirements. You don't have to put money aside. It's basically like as if it's as good as money, right? Whereas if you invest in a 20-year treasury, there is a capital charge.
okay.
It's called the SLR, solvency liquidity ratio.
Mm,
I think what they're going to do is they're going to change the rules around that. Scott Bessent and all of them have been talking about it, such that they'll incentivize banks to just buy loads of government bonds.
mm,
It'll make more sense logically than doing anything else, right? So you're just going to have like these certain entities that they're going to kind of incentivize. And also, I'm sure behind the scenes, there's going to be all sort of geopolitical pressure. Like, for example, we don't know what's going on with these tariff talks and stuff like that. They can be like, okay, I tell you what, we'll lower the tariffs, but you've got to refinance all that. You know, like you've got 30 trillion worth of our debt now, or I mean, no, wouldn't be that, but 2 trillion of our debt now. We want to see that grow by X, or,
there's a lot of
they
different tools they can use, yeah, and so it's difficult to kind of foresee, but it's almost like, as Lynn would say, is like a structural bid for treasuries because of those dynamics you've described, and they also will just rig the game and they'll manipulate the so-called free market so that there will always be that. If it was a true free market, I don't think many people would be running to lend the government money. But I think they just set the rules up in a way that it's kind of the incentives line up that way.
that's it, man.
Yeah.
And so, like I just think that Bitcoin is inevitable, right? And everything that we're talking about is inevitable. It's already baked in the pie. The horse is bolted. In Afrikaans, they would say, die kool is deur die kerk, right?
I don't know that.
It's over. It's too late, right? The problem, the setup, and what's coming, the causes of that are already behind us. There's no erasing them, right? What's coming is coming, right? And because of that, Bitcoin is inevitable, right? Because it's the hardest form of money there is. Like the stock to flow ratio of Bitcoin is double that of gold, right? So just I'm a great believer that in the end, common sense and logic prevail. Right?
Well, in the end, that's the ultimate thing, and nobody knows when that will be.
We
And
don't
I
know when
was,
that will be. It might take 50 years for the people around us to wake up. It may happen in the next five. I've got a feeling it's going to happen in the beginnings of it. The big move is going to happen in the next 5 years. And I think we'll see Bitcoin flip gold like
in the
over the
next
next decade.
a
And then
decade,
we're
there we go.
off to the races. But then Bitcoin will be a different asset. It'll be, a 30, 40, 50 trillion dollar asset, super liquid. It's always going to be more volatile because it can't be manipulated, but it's going to be a different asset. It's going to be more like a 21st century gold, and
Yeah.
then people are going to talk about it differently, think about it differently. Now it's seen as kind of like a speculative asset, like a big bet, like a punt
Yeah,
on
yeah.
some, you know.
Yeah, exactly. I think that is the perfect note to end it on because I was wondering where's the good news? But I think there is good news. We just don't know when it is. And I suppose it's good news for the folks who at least have built a position, developed some conviction. In the interim, we will do our best to persuade folks like your uncle, and people like in my family. But yeah, Glenn, it's been absolutely awesome talking Bitcoin and stuff with you. Especially being a fellow Sapper. And I'll leave all your details in the show notes if folks are interested in you and your work at Onramp and Acropolis. But yeah, what a pleasure, man. Really enjoyed this whirlwind tour.
Cool, Dale. Great to meet you, man.
Yeah,
And yeah, stay in touch.
thank you. All right, thanks very much, eh? Cheers.